Monetary policy uncertainty and a fragile Middle East ceasefire are pulling at global equities from both sides today. You are watching vTalkInsight, Equity Pulse Daily for June 18, 2026. Let's unpack how Kevin Warsh's first Federal Reserve decision and the evolving Iran oil deal are reshaping the equity risk backdrop. Global equities are heading into this Federal Reserve meeting with a mix of caution and resilience. After a strong run earlier in the week, U.S. indices have seen a couple of softer sessions, and volatility has edged back toward the high teens, but risk appetite overall remains intact. Markets broadly expect Kevin Warsh to keep rates unchanged at his first meeting, reinforcing a pause rather than an outright pivot. Two-year Treasury yields sit near monthly lows even as traders still price a high probability of another hike later this year, so the message from his press conference on future tightening is crucial for equity discount rates. The tension for the Fed is clear. Underlying U.S. inflation remains sticky, and AI-driven demand for commodities and infrastructure is seen as inflationary, while the recent collapse in oil prices is delivering a disinflationary impulse that takes some pressure off headline figures. Several desks see a risk that Warsh's tone is less hawkish than markets fear. If he leans into data dependence, steps back from aggressive forward guidance, and avoids talking up near-term hikes, front-end yields could fall further. The dollar may soften and equities could see short-term support, especially in growth and duration-sensitive areas. The opposite scenario is that Warsh underscores persistent inflation risks, labor market strength, and the possibility of additional tightening, even while holding today. In that case, expectations for a higher terminal rate and ongoing balance sheet runoff through maturing securities would keep financial conditions firm and leave long-duration equity valuations, particularly expensive tech, more exposed. Energy markets complicate the picture. Brent crude has slipped below $80 and even into the high 70s as traders price a prospective U.S.-Iran agreement, yet the Strait of Hormuz is not fully reopened and analysts stress that no meaningful supply has actually come back online. For equities, the macro message is that the inflation mix is becoming more nuanced rather than simply benign. The tone of Warsh's remarks on inflation persistence, energy, and AI-related investment will be central, together with how front-end yields, the dollar, and cross-asset volatility react in the days that follow. The biggest swing factor for the macro narrative remains the evolving U.S.-Iran Memorandum of Understanding. Draft terms point to sanctions relief, access to up to $300 billion in development financing, and plans to reopen the Strait of Hormuz, shifting talk from military threats to economic incentives. Oil prices reflect optimism about these developments, with Brent trading below $80 as markets price in the prospect of Iran adding as much as 1.5 million barrels per day of exports. But shipping through the strait remains impaired, and experts warn that any normalization in flows will be gradual and vulnerable to setbacks. That leaves a skewed risk profile. If a deal is signed and holds, reduced geopolitical risk could modestly support equities and reinforce disinflation, while failure or renewed conflict would likely hit risk assets hard given how far crude has already fallen towards pre-crisis levels. Beyond the Gulf, China is another drag on global cyclicals. Offshore Chinese equities have fallen sharply this year, with the MSCI China Index well behind the broader Asia benchmark, as weak retail sales, heavy discounting in the auto market, and a soft property backdrop feed through to earnings. European markets sit at the intersection of these forces. Cheaper oil and European investment bank support for green transition and defense projects are positives, yet heightened political risk, talk of renewed sanctions on Russia, and exposure to China-sensitive sectors like autos keep regional equity performance uneven. The structural story underpinning much of today's equity market remains artificial intelligence. Enterprise adoption is moving beyond experiments toward agent-based workflows, where autonomous software agents collaborate across functions and are managed through governance and compliance tools that resemble a new layer of digital workforce management. When deeply integrated into processes like claims handling or predictive maintenance, Advanced AI is delivering reported productivity gains of 40 to 60% for leading users. At the same time, soaring spend on model tokens in some firms now rivals salary bills, raising questions about cost control and how inflationary AI-induced demand for compute, energy, and infrastructure may become. On the capital side, the gap between US and European technology is stark. 8 US tech giants are valued at around $24 trillion, well above the entire stock's 600, and some US names now command valuations comparable to Amazon despite much lower revenues, while early-stage AI valuations are described as verging on bubble territory. Europe is trying to respond with plans for major European investment bank funding of AI infrastructure, but it faces fragmented regulation, high compliance costs, limited data center capacity, and a significant digital skills gap. Recent U.S. export controls on models from Anthropic have sharpened European concerns about dependence and accelerated calls for tech sovereignty, even as industry leaders warn that AI nationalism could fragment innovation. Capital markets are amplifying these trends. SpaceX has already surpassed Amazon in market value after its listing, despite a limited free float. NVIDIA's recent equity offering drew strong demand, and Goldman Sachs has advised on over $1 trillion of mergers and acquisitions this year, all pointing to abundant liquidity and a strong bid for tech and AI-exposed assets. At the micro level, autos are the standout weak spot in Europe. BMW has slashed its profitability outlook, guiding margins down toward 1 to 3% from as high as 6%, citing collapsing demand in China and geopolitical fallout, and its shares have dropped to multi-year lows, dragging down peers like Mercedes, Stellantis, and Renault. In contrast, the beauty sector continues to show resilience. Global beauty sales are growing around 3.5% to 4% annually, and L'Oréal has reported even stronger growth while boosting AI and digital investment and partnering with OpenAI to enhance both consumer-facing applications and deep scientific research. Media and consumer names offer a mixed picture. European media stocks such as WPP and Publicis are outperforming on renewed merger speculation, whereas Lionsgate has sold off after Netflix denied takeover interest, and La-Z-Boy has bucked broader furniture weakness, with an earnings beat attributed to portfolio restructuring, underlining how M&A narratives and execution quality are driving sharp single-stock moves. Stepping back, global equities are trading between two strong forces. On one side, Kevin Warsh's first Fed meeting, sticky core inflation, and a still strong dollar argue for a higher-for-longer policy backdrop. On the other, a tentative Iran deal, lower oil prices, and ongoing enthusiasm for AI, deal-making and issuance keep the risk-on channel open. Under the surface, leadership is fragmenting. Autos and China-sensitive cyclicals are under pressure, while beauty, select media, and AI-linked names remain better supported, even as valuations in parts of tech begin to look stretched. The balance of risks now turns on three things: how Warsh frames future tightening and balance sheet policy, whether the Iran memorandum moves from draft to durable peace, and how far AI spending and earnings growth can justify current multiples. We will continue to track how those macro signals and company-level stories feed back into equity leadership, sector rotation, and valuation risk in the days ahead. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.